undervalued dividend stocks to buy now at their 52-week low with huge upside. We're going to run through every single one's historical performance. We're going to take a look at their dividend safety, looking at their financial metrics as well. And as always, we will run them through our financial stock valuation model, getting to the intrinsic value and acceptable buy price given our investor margin of safety. And we'll also touch upon Wall Street's price targets over the next 12 months. Now, each one of these have some huge upside, so let's jump straight in with the first one, which is DVN, Devon Energy Corporation. Now, over the last year, they are down around 33%. They are pretty much now trading at their 52-week low, and we can see a forward PE of 7.2. Now, if you've been holding this company over the last 10 years, you would be down around 18%, and we can see their all-time high at the back end of 2022 at around $71. So let's take a jump straight in. Dividend safety score, borderline safe 41, market cap 26 billion, a large cap company. And when we take a look at those recessionary metrics, well, last recession, they maintained the dividend. They had below average growth of negative 57% versus the S&P's negative 12%. And we can see a near S&P return, negative 54% for Devon Energy, with the S&P returning negative 55%. Dividend growth, well, we always love to take a look at this. Now, 162% increase over the last full year. 85% on average over the last 5 years, and over the last 20 years, 22%. So very strong, in fact, well above that minimum 4% we advocate on the channel to keep up in line with inflation. And we can see that shown here on the graph. And in terms of consecutive increases, they have been increasing those dividends for the last 5 years, as we do see that dividend cut in 2015. So let's take a look at dividend yield theory. Now, it states that the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, 7.01 versus 4.27. Another sign of undervaluation with the forward PE 7.4 versus the 5-year average of 8.5. So a double sign of undervaluation, but always bear in mind we're not looking at any of these models in isolation, and we'll draw our conclusions towards the end. Energy sector PE is also significantly higher at 12.2 versus Devon 7.4. Now let's jump into the payout. Now, typically we do focus on the free cash flow payout. The reason for this, for those that are new to the channel, earnings is susceptible to manipulation by management through accounting. My personal preference, below 60%, you can bring it down to 40% for oil producers. So what we can see over the last few years, it has been fairly high. Now, this is one reason why we do look at the free cash flow. 2019, we can see 108%, which means they paid out more in dividends than they generated in free cash flow. If you were to look here at the earnings, 25%, you would have got a different story from these numbers. 2022 came in at 99%, a bit too high. The positive is 2023's annual report is expected to show 77% for Devon Energy, 2024 even lower, so they are bringing that down, which is positive news to shareholders' ears. Now, free cash flow per share, negative 329 in 2013, 523 in 2022. It is increasing, but do know the inconsistencies, a significant number of years negative growth, and 2023 is expected to be slightly higher than 2022. But again, also bear in mind, and we'll see that from the sales growth here, the cyclicality and volatility of this industry, and therefore we see some years of double-digit growth followed by double-digit negative growth. 2023 we can see negative 21%. And that is quite clearly shown, the cyclicality, when we look at the total sales, although it has gone up from around 11 billion in 2013 to 19 billion in 2022. They've also done share issuances. As we can see, it has gone up from 402 million shares outstanding to 645. So they are diluting your position as a shareholder over the last 10 years. ROIC, again, very volatile due to the nature of the industry, but the last 3 years have been very strong double digit to that ROIC figure, and we do like to see above 10% or more on the channel. It does give us faith that management are able to effectively allocate their capital. Operating margin, very inconsistent, likewise on the free cash flow, but we can take some faith in the fact that the last 3 years have been very strong, above the minimums on both of them. 19% on the free cash flow in 23, 33% to the operating margin. Very positive to see, but do bear in mind there may come a time where it does come negative depending on that area or the time or the cyclicality that we're in. Net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, shows us two things: the dividend safety as well as the strength of the balance sheet. For oil producers, we want to see below 1.5, so this is the number of years it would take the company to pay off all of their debt net of cash on hand. 2023 expected 0.77, so it is below the 1.5, so we should still expect to see those dividends come in, and the balance sheet isn't looking worrisome at the moment. So let's jump into the valuation of Devon Energy, and as always the intrinsic value here is just the average of these four models, and we can see for today's episode of Devon Energy it's coming to $57. Now, a current price of $41. On the channel we typically start off with a margin of safety of 10%. We use this if we believe it has a wide moat, strong financial metrics, good forward-looking data. So it is a buy up to $51 if we believe so. At 15% still a buy, 20% we can see there is some significant margin of safety, and at 30% it isn't too far off the current price. So we'd say at least a 25% margin of safety with Devon Energy right now. What do Wall Street forecast for this company over the next 12 months? Well, they have a price target slightly lower than the intrinsic value of $54, so they see a whopping 32% upside. They do believe it is a strong buy right now. As always though, with each one of these that we run through, always do your own due diligence, but do let us know in the comments whether or not you have been buying or are looking to buy any of these that we run through. The next one we are going through is one that has been hammered and we have discussed on the channel, so do check the deep dive if you're interested. Alibaba Group holding, now they are down 41% over the last year. They are now into the 60s, as we can see the 52-week low. They do offer a dividend recently established 1.44% and a PE of under 8. Over the last 10 years, if you have been holding this, you can in fact see that in 2014 it was trading at $88, so you would be down right now. And we can see the all-time high does sit over $300, a long way away from the current trading price. Now, we don't have a dividend safety score as they have just recently started paying dividends, and the market cap is sitting around 174 billion, a mega cap company. So let's take a look at the free cash flow payout now. Because this is the first year, it is expected to be around 11%, which is very low. So I would expect to see double-digit growth from Alibaba Group this year for the dividend, which will be a good news for those investors who have been struggling if they have been buying this stock over the last few years. Free cash flow payout, well, free cash flow per share, in fact, very strong, $10 in 2014, $63 in 2023, so more than 6 times growth over the period. We do see the dip into 2022, but it did rebound well, and 2024 is expected to be slightly higher. So this is a very strong company. The free cash flow per share generated is very high, so that is good news to note. Sales growth, a few things I would just comment on here. Double-digit growth, we love to see this, typically 3 to 7%, but the fact that it's double-digit is very impressive. The only concern is that we can see it decrease over the longer term, 2023 at 2%. Now, is this a case of Alibaba's growth starting to slow down significantly, or was this a one-off and will we see it rebound into 24 and beyond? Something just to consider for investors and potential investors. Total sales, very nice to see the growth, 53 billion to expected 915 over the trailing 12 months. So very, very positive, and lots of growth to the top line. Shares outstanding on a net position, they have diluted your position as a shareholder if you did purchase shares in 2014, going from 2.33 billion to 2.59. In terms of ROIC, it is pretty much consistently around 9 to 12%. I would like to see it around 10% or more, but given it is consistently around that level, it is something that I could deal with over the longer term. Operating margin and free cash flow margin, kind of the same story that I was trying to paint when we were looking at their sales. Fantastic numbers over the older periods, over the last 10 years, 2014 and the few years after, on both the operating and free cash flow. But it has started to come down on both of them, so something just to consider. Are their margins being suppressed over time on both the operating and free cash flow, or is this a story where it will rebound in 2024 and beyond? Net debt to EBITDA, absolutely fantastic, showing us one, that dividend is safe at 1.44%, and two, their balance sheet is very strong. Wouldn't even take them one day to pay off all of their debt net of cash on hand. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So the intrinsic value now at $146.35. We can see the margin of safety, 10%, it is a buy up to 131. So we can see already there is significant margin of safety with Alibaba. At 55%, you'd have to wait till $66. So right now, based on our estimates and judgments, now we see around a 50% margin of safety. Now, we haven't included within this margin of safety the risk, the essential risk with China, the regulatory risk. So there are some things to consider, and that will depend on your margin of safety and your investment thesis. In terms of Wall Street, well, they have a price target of just under $120, so they see a whopping 72% upside to this stock, which I do know in the dividend community and the community in general for investing is very controversial and very polarizing. So let me know whether you have been buying, as it has dipped under $70. One thing that I will say for me personally on this stock, as it has come down under $70, I will be considering adding this to my portfolio. It won't make up more than 1 or 2%, but I do now see that the rewards are worth the risks that we are seeing in the market and extending to the China climate. But again, this is coming down to your own individual risk reward ratio. So let's jump on to stock number 3. We have a National Fuel Gas Company. Now this is one that has been down 19% over the last year. It is trading at the 52-week low, and it offers a nice yield of over 4% with a forward PE of just over 9. Over the last 10 years, if you've been holding this company, you would be down around 34%, and we can see 2022's all-time high around $74, although it did hit that as well back in 2014. So let's take a look. Dividend safety, very safe, a 95 score, 4 billion market cap, a mid-cap company. In terms of recessionary metrics, well, they increased the dividend during the last recession, below average growth, but also beat the S&P at negative 40%. Dividend growth, 4.2%, probably the minimum I would be satisfied with. As I mentioned, it is just keeping up in line with inflation. 3% over the last 5 years, 3% over the last 20 years. Not that great, but again, it does really depend on whether or not you are satisfied with that 4 to 5% yield over time. One thing to note though, very important, they are a dividend king. They have been increasing those dividends over the last 50 years or more. On top of that, they have been paying dividends for 122 years without a reduction, and a phenomenal feat that we only see with a handful of companies such as Chevron, Exxon, General Mills, and a few others to note. So in terms of essential undervaluation, we have that sign of undervaluation on dividend yield, 4.14 above the 5-year average. The same can be said for the forward PE, 9 versus 12 on the 5-year average. And we can also see it is significantly lower than the sector PE of utilities of 15.5. Now, one thing that I haven't mentioned in quite some time is just because a company is towards its 52-week lows, it doesn't necessarily mean it is undervalued or a buy signal, and the same applies when a company is at its 52-week high. It doesn't necessarily mean it is overvalued or a sell. Now, let's jump into the free cash flow payout, but what we have to bear in mind with utilities, because they are a lot more volatile, we do focus on earnings for utility companies. So let's take a look. Below 75% for utilities is the preference. 2023 at 38%, and typically over the last 10 years it has been fairly low, so that is a positive sign and one that we can see why it has a dividend safety score of 95, making it very safe. Earnings per share, it has increased over the period, 343 to 517, but again, just something to consider, it is very inconsistent. So just remember that you are investing in the utilities company as opposed to, say, a tech company. So as you understand the industries and the way they grow, you won't be surprised with inconsistencies across the board. Sales growth, again, volatility of the industry. We do see years of double-digit growth followed by double-digit negative growth and so on. Just to point out, 2023 was negative 1% to the top line. And over the last 10 years, it has gone from around 2.1 billion to 2.2 billion. On top of that, with utilities, it is very common, similar to REITs, they do dilute your position over the longer term, issuing shares. The reason for this is they do rely on issuing equity to fund a portion of their growth expenditures. Now, moving on to ROIC, actually pretty solid for a utilities company. It is above 7.5%, which we do lower from that 10% on the majority of companies. 2023, 11%, very healthy overall. So for this, I do give a good green tick to management when analysing national fuel gas. On top of that, operating margin very healthy, well above the 18% on the utilities, and the last 3 years have been very strong in the high 30s. Now let's take a look at the net debt to EBITDA. We can see below 5.5 every single year, which is the preference for the utility industry, 2.26 in 2023. So I can see now why that dividend does look to be very safe. So jumping into the valuation of NFG, and one thing to note, typically on the channel we do run through every single one of these models to get to our intrinsic value. If you do want to grab a copy of this model, do click on that pinned comment below, and you can run your own companies through the intrinsic value calculator to get to the acceptable buy price of companies in your own portfolio and those in your watch list. So for NFG, let's jump in and we can see a margin of safety of 10%. It is a buy up to $51. At 15%, pretty much at the current trading price. So we see around a 15% margin of safety. Wall Street have a price target of $67 with 39% upside over the next 12 months. Another very strong buy in terms of Wall Street, but it is very important for me to emphasize that you should never copy what Wall Street are predicting and always have your own investment thesis, as it isn't uncommon for their price predictions to be wrong. Now, before we do jump into the next stock, just to let you know that I am doing a weekly newsletter and it is completely free if you do want to click on that pinned comment, so you do get these emails every week. We'll discuss through here the 7 golden dividend metrics that I calculate for stocks that I want to invest in. I update it with stocks on my watch list, as well as running through companies that we've gone through on the channel with the margin of safeties that we have used for each one. Completely free, and if you do want to check that out, do click on the pinned comment. It is completely free. So the next company we have at its 52-week lows is Louis Vuitton. Now this is down 15% over the last year, trading right there towards the 52-week lows with a yield of just under 2% and a forward PE of 20.66. Over the last 10 years, well, it has had some nice growth, up 317%. Bear in mind this doesn't include those dividends reinvested, and we can see its all-time highs in summer of 2023 at just under $1,000. So let's take a look at this company. Market cap $359 billion, a mega cap company. Dividend growth, lots to love. 20% increase, double digit over the last full year. 19% over the last 5 years. 14% again, double digit over the last 20 years on average. Absolutely phenomenal. And one thing to note with this company, we have done a deep dive on it on the channel if you want to see this in more detail. But one thing I will mention, their CEO has been buying a lot of shares of this company, and typically insider buying is a very bullish signal. Again, check that out. We do run through that in more detail. Free cash flow payout, it is below the 60% I look for over the longer term, and we can see 2023 expected 59% when their annual report is released, so that is positive to note. Free cash flow per share, $6 to $25, so we can see 4 times growth over the last 10 years. Do note it is expected to come down in 2023, but then expected to rebound up to around $32 in 2024, so that is positive to note. Sales growth, nearly double digit every single year. We do note that COVID drop, which does make sense and is justified. It rebounded very strongly. And even in 2023, we're expecting to see 17% growth to the top line. And I do believe they aren't too far away from reporting their earnings. So you can see that numerically then, 29 billion to 79 billion in 2022. One thing they don't really do is share buybacks. We can see it has reduced by around 2 million, but realistically over that long period, that is very trivial. Now, when we look at the ROIC, remember, I only personally like to invest in companies that have 10% or more. And over the longer period, what's important to note is, in fact, it has actually been increasing, which is very good. And 2021, 22, and 23 are expected to be around 22%, 21% in fact. Free cash flow margin, operating margin, again, it has been increasing. The last 3 years, around 27 to 26%. And on the free cash flow margin, whilst it has dropped, it still sits above the 7% minimum. So at 12% in 2023, that is still looking positive, although it could be something just to keep an eye on. On top of that, the net debt to EBITDA has been coming down, 22 at 1.57, 23 expected around that at 1.62. So the dividend does remain to be safe and the balance sheet does look to be healthy. So let's jump into the valuation, getting to the intrinsic value. Now today's episode for LVMH, we have an intrinsic value of $956. Now, margin of safety, as always, we start off with 10%. It is an acceptable buy up to 860. At 15%, 812. And at 20%, again, it is showing a 20% margin of safety. 25%, it isn't even too far off. You are talking a few dollars, so you can argue between a 20 to 25% margin of safety. In terms of Wall Street, what they're forecasting, well, they see 30% upside, another strong buy by Wall Street with a price target of $942. Now, there have been a few companies in here that we have discussed that I am looking to buy and add to the portfolio. This is another one of them, Alibaba and LVMH, but do understand both have different risks. Again, these are luxury products. If we do hit a recession, it could be one that does get hit on the top line, and it is one that I will be eagerly waiting for their earnings report to decide on my next move, whether or not this becomes a new addition to the portfolio. Do subscribe and hit the bell button though if you do want to see that analysis when their earnings report does get released. We then move on to a new company that we haven't reviewed on the channel, Nutrien Limited. Now, it is down around 33% over the last year. It is at the 52-week low, and we can see a yield of over 4% with a forward P of under 11. Over the last 10 years, or if we even go to the last 5 years, we can see it is pretty flat, and it did hit its all-time high in 2022 of $115, more than double the current trading price. Dividend safety, 41 borderline. We can take a look at that shortly. 25 billion, it is a large cap company. And in terms of those recessionary metrics, well, they didn't pay a dividend in the last recession, and they had below recession growth. Dividend growth, though, lots to like here. Double digits last year in February at 10%, so we should be expecting another increase over the next few weeks. 37% over the last 5 years and 19% over the last 20 years. A very strong contender for a very big dividend growth company. But do note they have only been increasing those dividends for the last 5 years, as they did cut the dividend in 2015 as well as 2016. In terms of dividend yield theory, well, we can see that sign of undervaluation. 4.12 versus 3.29. Again, the same on the forward PE at 10.9 versus 13.9. And we can see the materials is a much higher at 17.8. So let's take a look at the free cash flow payout. Remember, below 60%, but you can bring it down to 40% for chemical producers. Over the last 10 years, it has been very inconsistent. We do note some years where it did pay out more in dividends than generating in free cash flow. Although 2022 at 18%, 2023 at 37% is positive, and I would expect a nice strong double-digit increase over the next few weeks. Free cash flow per share, well, $1.84 to $10.50. Again, it didn't really have much movement for quite a significant number of years over the period. And do note, 2023 it is expected to drop. So a few different things just to consider and maybe take a closer look. Sales growth, very inconsistent, but again, you could argue the cyclicality of the industry. We see 4 years of negative growth, followed by lots of positive growth, and we do see 2018 an incredible year. But again, another thing to note, 2023, they are expecting a reduction to the top line. Numerically, though, it has gone from 7 billion to 30 billion expected in 2023. On a more positive note, one of the few that we've reviewed today that do return excess cash to shareholders by doing share buybacks, reducing the share count from 874 million to 503. In terms of ROIC, inconsistent, some years above 10%, some years below. More positive is the last 3 years, it has been above 10%, 23 expected at 11. Operating margin, free cash flow margin, more positive news in my opinion. The last 3 years have been above 15%, as well as the last 10 years, 2013 to 2015. And the free cash flow margin nearly every year above that minimum 5%. So it is a bit of better news when we have compared that to their total sales. Net debt to EBITDA 0.96 in 2022, so it is below the 2.5 for chemical producers. 2023 though, it is expected to go slightly higher than that 0.96, but slightly lower than the 2.5, so something just to consider, and we can start to see why that dividend may be on the borderline safe scale. In terms of the valuation though, let's get into it, and we can see the intrinsic value for today's episode does come out to $64.48. So let's run through the margin of safety as always. Don't forget, 10% is used if we believe it has a wide moat, strong financial metrics and good forward-looking data. And right now we see around a 20% margin of safety based on our estimates and judgments. What do Wall Street see? Well, they see a price target of $71 with upside of 39%, another company that they do see as a strong buy. Don't forget, drop your comments as we do go through these and let me know whether or not any of these you have added to your watch list or you are considering to buy. We then move on to the final company. We have AEE Ameren Corporation, down 20% over the last year at the 52-week low with a yield of 3.64% and a forward PE of just under 16. Over the last 10 years, though, you would be up around 96%, and we can see it a few times in 2022 at its all-time highs at just under $100. Dividend safety then, 69. It is safe. Market cap, 18.2 billion, a large cap company. Recessionary metrics, well, they cut the dividend, average growth, and also slightly underperformed the S&P with a negative 60% return. They did have a nice increase last February, 6.8%. So again, we are expecting an increase over the next few weeks. Last 5 years at 6% and very decent. Last 20 years, 0% isn't the greatest, essentially not keeping up in line with inflation over the longer term. And we do see that dividend cut in 2008. Although do note they have been increasing those dividends for the last 9 years. So jumping into dividend yield theory, we see that big sign of undervaluation, the highest yield offered for AEE over the last 5 years and above the 2.64. Likewise, the forward P, the lowest forward P they have had over the 5-year period with the average at 21.5. Now in terms of sector P though, it is fairly in line with the utilities 15.5. So jumping into the free cash flow payout, remember this is a utilities company, therefore a lot more volatile, so we focus on the earnings. It has been pretty much below 75% over the last 10 years and is decreasing. 2023 at 56%, that is positive news, so that dividend does look to be safe so far. Again, very nice to see some nice consistent increases over the period with the earnings per share more than doubling, 440 expected in 2023 and expected 461 in 2024. Sales growth, although we do see the cyclicality and volatility, it has been growing fairly decently over the last 10 years, around that steady to moderate growth of 3 to 7%. Last 3 years looking fairly decent, 10% in 2021, double digit 25 in 22, and 23 expected 7%. Overall then it has gone from around 5.6 billion to 7.7. One thing to note with the similar utilities company we analysed earlier, they do issue equity, they do rely on this, and therefore we see it go up from 245 million to 262. Taking a look then at the ROIC, above 7.5%, remember for utilities, we do see it straddling around that for the majority, although it has decreased to 6% in 2022 and 2023. Operating margin, very nice to see. It is above the minimum 18% and consistently, and 24% is the expected target rate in 2023. Net debt to EBITDA, something just to keep an eye on. It is right there at 5.5 in 2023. So again, just something to keep an eye on as you don't really want it to go any higher, and we can see it has been increasing over the period. So something just to consider, to bear in mind and to keep an eye on moving forwards. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, you can click on the pinned comment below to grab a copy of the valuation model, as well as signing up to that free weekly newsletter. Margin of safety then at 10%, we can see it as a buy up to $80. 15% a buy up to $75, 20% a buy up to $71, 25 and not there yet. So right now for AE, we do see around a 20% margin of safety. What do Wall Street forecast? Well, their price target is $85 and they see a nice, reasonable 22% upside over the next 12 months. As always though, do let me know your thoughts in the comments below. Are any of these you have been adding to over the period, or are any of these that you do believe aren't going to have as much upside as Wall Street? As always, do your own due diligence, never rely on what Wall Street say, but do let us know if any of these do interest you. As always, have a great day, smash that like button if you enjoyed today's content, catch you all in the next episode and take care.